I have a lot of clients these past couple years that have moved a little bit farther out. Maybe it was too expensive here in the core of Collin County to purchase, so they moved farther north to Salina, to Princeton, or to Prosper. And they bought either a brand new build or a newer home. And they were trading location for either a bigger home or a newer home. And a couple years later, I've had many that have come back to me and said, you know what, we didn't like the move, we want to move back. But the concern is, okay, if I've owned this home less than 2 years, but now I have equity in it and it's appreciated since I've owned it, what are the implications on taxes? So we're talking here about long-term versus short-term capital gains. So short-term capital gains is any gain realized over under 2 years of ownership. So whether it's a stock, any sort of investment, if you own it less than 2 years and you sell it in that time and realize a profit on it, you're going to get taxed on short-term capital gains. What does that mean? Well, that means you're going to get taxed at whatever income bracket you're at. So if you're at 20%, 24, 27, 29, 32, whatever, there's like a dozen tax brackets now. Whatever tax bracket you fall in at the end of the year, that's what you're going to get taxed on. Do we know what tax bracket we're going to get taxed on? We're now in tax season, right? The year's over. So we should have some idea. If not, maybe you can refer to your 2022 tax returns to see what bracket you were in there. It's going to be pretty close, but chances are very high that regardless of what tax bracket you're in, it's going to be higher than the long-term capital gains. Long-term capital gains is you own it over 2 years, you make a profit on it. When you sell it, you're taxed at a flat 15%, which is much better. 5, 10, could be almost 15% better, actually could be almost 20% better than some of the tax brackets that are out right now. So it is important to know exactly when you bought it and be able to plan out when you're going to sell it. Now, you can list the market before that 2 years as long as you don't close on that property until 2 years and 1 day after that time has elapsed from when you bought it. That 5% on a $50,000 gain, for instance, that's $2,500. That's no small chunk of change. But if you bought in some of these places, like for instance Salina, and it's appreciated $200,000 in that time frame, then just 5% on $200,000, that's 10 grand. Now, that's only if you're going from 15 to 20%. If you're in like a 32% tax bracket, now you're talking about a 17% difference. That is a huge chunk of change that you don't want to incur if you can avoid it. Sometimes just waiting a little bit can save you thousands, tens of thousands in this case of dollars. So be cognizant of the implications of long-term and short-term capital gains, and also be aware of the exact date that you bought it and the exact date that 2 years lapses for you.